We're looking at the top 6 gold mining companies on the ASX over the last quarter. The best are up over 100%. Some of them are 400% in the last 3 months, and 3 of them have put on more than 120% in the last month alone. What's driving this movement? We're going to look at that in detail, but there are 3 key factors. One of them is central bank buying. The other one, it's a de-dollarisation. So many countries, many countries, have moved away from the US dollar as their reserve currency. And then the third one is geopolitical issues layered on top of each other. What does this do? Well, this helps us identify which companies on the ASX are trading the best, and that's the gold thematic that we're drilling into right now. So have a look at the table on screen. The top 6, you've got a bonus. Top 7 small cap companies are up massive returns. We've highlighted the quarterly column, 200, 187, 392% in a quarter, huge. We've also put in there some familiar names, because normally when we're trading gold on the ASX, if we just quickly want exposure without a lot of research, we jump into the big names, the producers. Your Ramelius, your Sandfire, your Northern Star, your Evolution. They're the bigger names, and we can see they're up 30, 40% in the quarter, between 10 and 25% in the month. That's good, but we're going to really look at the charts of the best performers to see where those trading opportunities are and how they came about. And then for context, we've got the gold, the Global X ETF, the one that we all know, and it was the first one on the ASX, 17% for the quarter. That's the movement in gold, the commodity in Aussie dollar terms. Toggling through the charts, what we're going to do is drill in, because the context of this movement is quite exciting. What we're looking at is the 5-year chart of the gold ETF that we just looked at. So notice here that's from about, well, $24 up to $56. That's a solid move, but it doesn't give us the full picture unless we look at what's happened in sort of the last 20 years. And this gives us a better idea of how much stronger this rally is than what we've seen in the last decade. So zooming in, we're going to see we're up to about $55 on the gold ETF, whereas only back in sort of the 19-20 period, 2019-2020, we were at sort of $15 on the ETF. So we've more than tripled in what's happened here. And most of that rally has really happened in the last 2 years. We've seen something similar to this before. Way back at the start of my career, it was right here where I started, 2005, 2006, 7. We saw the movements. So from the gold ETF, just to compare apples with apples, we had a gold run, sort of $5 getting up to 15. We trebled in price on the gold ETF, Aussie dollar terms. We've done something similar over the last 5-6 years, and most of it has flicked up in the last 2 years. Similar thing happened here in 08, 09. Okay, so we've got some context. We've seen this story before. How does it happen and how do we trade it? So the best performers, I love this chart here. This one's the best, DTR, because it tells us how strong a leader can lead and how much we should really be focusing on those leaders to lean in for the opportunities. The 20-day moving average is this green line. It hasn't touched it since it broke out in May this year. The 10-day is the light blue line, and it's ebbed and flowed around it, given it opportunities. Sort of a VCP, a cup and handle, and then a high and tight flag. Setups that we love. But these are setups that we need to know when to lean into and when to look for new opportunities. This is not a market for looking for new opportunities. Right now we're sticking with the leaders, and we'll get to that in a second as to how we can stay on top of that and know that is what our focus is going to be. So DTR, it's a strong leader. Did we know it was a leader? Well, this is something that we've created, which is the momentum score, which is the purple line above, and then ranking those momentum scores every single day. The purple line that's the momentum score, and that tells us it's been going down since May. So has it been underperforming? No, we just saw it's one of the best performers. And the momentum score has been dropping off. But it's actually been one of the best performers almost every single day since May. How can we tell that? These orange X's in the bottom chart, this is the daily calculation we do of the top 30 momentum companies on the ASX every single day. And that gold cross, or that orange cross, that's when it was in the top 30 every single one of those days. So that really tells us we've got to keep focusing on the leaders. And that echoes time and time again. When we look at these top 6 videos, it's always we want to stick with the leaders. Here's another one on the list, TMB. So their performance, 209% for the quarter and 128% for the month. You can see that huge jump. Buyable gap up, episodic pivot on the news, high tight flag being created, and maintaining in the top third, top half of that range. Love to see that. We went into these charts in more detail on last Friday's video if you want to go and have a look at that. But we're just focused on these gold leaders right now. FML, huge movement. It barely gave us time to jump in on a high tight flag. There was a little congestion here. If you were lucky and smart enough to get on top of it and pop through that, it's just kept on powering and more than doubled in price. That's what we love to see. It's rare, but when we do see clusters of these high and tight flags, that's when we have to lean into these leaders. Because this is not advice, we've got the disclaimer at the end. This is FML, similar chart before, but we can see the momentum has actually been increasing. This purple line tells us the momentum score is getting higher and higher as it's ramping into that high and tight flag and pushing and surging through. Demand's getting higher and there's a higher competition for price. The little blue diamonds, that tells us, this on the bottom chart, the blue diamonds tells us when it showed up on that Launchpad list. That's another daily report that we create. Normally the Launchpad then leads into these orange crosses, which are when it's a momentum leader. And we've seen it being a momentum leader so many times in the last 2 or 3 months. And we're going to see that last 2 or 3 months has been one of the best times on the ASX in years. KGD, another high tight flag, liquid, hard to trade, low capitalization. Nonetheless, it's a high tight flag opportunity. We love those setups. KLR, this one is an example of how we can get our fingers burnt in this type of market. It can roar up, moving from sort of 40 cents all the way to $3.20 in a day. That's just insane, that sort of movement. If you've bought up here, definitely want to be having stops in place because they've been torn apart. Even if we bought after sort of a reaction, 80 cents, there's still a stop here. They're down 50 cents if they haven't stopped out. So this is why portfolio management, risk management is absolutely crucial for momentum trading. While it's still a top performer, there's so many traders are actually underwater on this one, despite gold being the best thematic that we've got. ALR, another small cap, but you can see this accumulation in volume happening in August and then just pushing on through. So good steady riser there, hasn't had too many heavy pullbacks and volume's been pretty well concerned, quite tight as concerned. SFR, so we're looking at this bigger names here. If we're going to be trading a portfolio client and we want gold exposure into gold producers, then these companies actually filter into the gold ETFs, the gold miners ETFs. So Sandfire, we're seeing a movement from August at around $11 or $10 from the lows, all the way up to $16, $17, but it's coming off the boil. We're going to talk about that in a second, about the importance of the gold price and profitability and how it can be exponentially different, particularly for those small miners on the fringe. We'll talk through another couple of the large ones in that table that you've seen, but this is where we're going to talk about how we know when to lean into these top opportunities. Where we've highlighted in the green, these are the times in the last 14, 15 months that have been the best momentum market that we've seen in that whole period. So 96%, that tells us that today or Friday was better than 96% of the days in the last 14 months. The only ones that were better, the top 4%, they're all within the last month or two. That's how good the momentum trading has been on the ASX. So this one and the next one, this report tells us when to lean into the top momentum companies or when to actually look for the rotation of a new theme coming to market. The green line tells us, the green highlight shows us it's just been getting better and better and better. What's better? The probability of finding any random tradable company on the ASX go up 10% within a month. And it's just been getting better and better. Why? Well, partly because we've got so many gold miners that are just pushing up and other mining companies that are coming into the fore, more volume, and that's all antithetised through the small caps index. The XSO, if you want to look that one up, that's the small caps on the ASX, and it's been completely roaring and left the top 200 behind. If you're trading banks and the big companies, probably best to have a look and explore and understand what's going on in that small caps because there's so much opportunity, an abundance of opportunity. Within that index, we then ask ourselves, well, do we look at the leaders like the small caps, the golds, and the other commodities that are still pushing on higher, or do we try and identify the next one? Is it an industrial or property or infrastructure or something that's going to take charge? The data tells us no. Stick with the leaders. These are 2 reports that my members get every single day on their portal, and then they use that information to then filter through these types of companies and toggle through the top RSI, top 15% of RSI on the ASX, filter them, rank them, pull these charts out and go dissect for the best opportunities. that's what we're doing, and that's what members get. And then also this video, we're going to go into detail of those 6 and 7 leaders that we just talked about. In a podcast, it's for members only. If you want more detail on exactly what the updates have been to those companies and how they time with the leadership, that's what those podcasts will do. It's an extra bonus for those who follow us on YouTube. Now, this is where we get to the part of talking about those thematics that we talked about, because the gold miners that we've had on the ASX that rallies in the last decade, they've sort of come and gone. They haven't been as strong-lived as what we've got right now. So what's different about the current drive in the gold market that's helped push it and create this opportunity? Okay, so it's central banks, and this is quite interesting, because when I did this research, I was surprised at what I found. The institutional buying is massive. We've got about 100,000 tonnes plus per year. What does that mean? Well, it's the highest sustained buying we've had in over 55 years. That's a key factor. What we've had in 2022, we had just over 1,082 tonnes, 2023, 1,037, and then 2024, 1,044 tonnes. We're still going with 2025. We'll see what the numbers are at the end. But that's sustained purchasing. It can come in ebb and flows depending on, say, political changes, monetary policy changes, all dependent upon the individual central bank. But when you have them all buying gold at the same time together, without ebbs and flows of monetary policy, fiscal policy, budget updates, government changes, that kind of thing, austerity measures, they push the price up. So they're partly the reason why we've seen sustained movement for sort of 4 or 5 years that we looked at the start. What was the catalyst? I wasn't expecting this. It's Ukraine. So in February 2022, look at the gold price. Scroll back through and have a look at the charts. Russia's $300 billion in frozen assets at central bank assets became a problem and a concern. So that triggered the global de-dollarisation acceleration. We'd had commentary before from the BRICS, but then suddenly so many other countries jumped in and thought, hang on, if I get offside with the US, what happens to my reserves? That really hinders my country's ability to pay their debts and so on. So that led us into the second one. But before we move into the second theme, let's just understand who the biggest buyers are. Poland has added 67 tonnes year to date for 2025. Big buying. So they're targeting 20% of their reserves in gold by 2026. So they are out there and they're buying hard and fast. They are aggressive in that buying. China, as we'd expect, but there's 316 tonnes added in November 2022 through to May 2025. So that's progressive buying since the start of really the Ukraine war, and it became obvious what was happening with sanctions. The actual purchases, well, they're rumoured to be more likely to 2 to 3 times higher through off-market transactions. We can't validate that, but it is showing through in the gold price. India, they've added 100 tonnes, and that's repatriated from the UK storage, bringing that one home. Azerbaijan, 26 tonnes in 2025. Kazakhstan, 25 tonnes so far in 2025. They're the largest purchasers in the recent times. That gives you an idea of all of them competing in the same global market to buy physical gold. And there's not a lot in the world. So the total holdings, we've got central banks collectively hold about 36,000 tonnes globally. Second quarter of 2025, we've just finished the third quarter in September. 166 tonnes. That was 41% above historical averages. Remember how we saw that flick up of the gold price so much in the last 2 years? We're understanding why now. Now, 81% of central banks are planning continued accumulation. This isn't changing. Last night, or Friday night, we had Bitcoin off about 12%, NASDAQ off about 3%. Gold prices were up 1%. So when it's a risk-off asset and people are flooding into inflation hedges or risk-off assets, was that Bitcoin? Was that gold? Well, Friday night told us it wasn't Bitcoin. There was $7 billion worth of Bitcoin sold in about an hour. That's staggering. But gold was bought and bought up. Maybe they bought gold. Then we have the de-dollarisation. This is the second thing. So this is the reserve currency shift, partly off the back of what happened with the Russian assets being locked up by the US. So we've got US dollar reserve. This is quite interesting. Over about 2 decades, 72% of global reserves were in the US dollar. So that was after September 11. 72%. In 2024, that was only 58% of global reserves. Massive drop. So that's a 14% drop. That is huge because the money had to go somewhere else and it wasn't to the US debt and it wasn't to their bonds. So quite possibly gold. But gold hasn't been running for 2 decades. Remember, it went sideways for a long time. The BRICS, well, their US dollar exposure, that's reduced from 65% to 45% between 2018 and 2024. So a 6-year period, they dropped, well, more than what the rest of the world has. So they're really accelerating that. I don't have data for 2025. We'll see what happens. Gold's share of reserves. The current global average is about 18% for gold. Excluding major Western holders, that's about 11%. Historical comparison, the 1950s, it was about 70%. Now, China, they've got official reserves of 2,226 tonnes as of May 2025. They added 316 tonnes. So they're the world's largest gold producer with 375 annual output. You can see most of that possibly just going to the central bank. Obviously, it doesn't exactly happen like that. Now, Russia's response to the sanctions. Gold reserves, 2,336 tonnes. So that's about 30% of the total reserves. And that's up from 22% before the Western sanctions. So they've moved as many dollar assets as they can and new deployment of reserves into the gold market. So they're also accelerating that gold purchasing side of things. So we are seeing a huge amount of money. So that's the third one is the geopolitical tensions. What we're looking at from instability driving safe havens. This is the other factor that sort of, when you have this backdrop that we've just described, gives you real context of what is happening and how this possibly isn't going away anytime soon. We've reached the $4,000 ounce. Now, historically, we don't see gold consolidate at these sort of levels. It ramps up quickly and gets belted quickly, finds a low, and it's very erratic in that sort of sense. Not like a company where it can build a base for weeks or months or years. Year to date, it's up 54%. Current range is generally between $3,600 and $4,000 US an ounce. Total cumulative 2-year gain is over 103%. Now, we've got the issues with the French political crisis, we've got Japan political instability, we've got the US government, the prolonged government shutdown that's happening September, October 2025. Yes, that adds to political instability. We've seen that movie many times before. But you add in France, Japan, UK, they've also got issues post-Brexit. And the US government is a very different regime to what it's had before. Then you add in the geopolitical conflicts, Middle East, Israel, Gaza, Iranian tensions, Ukraine, Russia, China, Taiwan, and NATO, Russia. All reasons independently to add to gold in the history of the last 2 decades or so, or longer. Then we've got the VIX sort of things. If the market does actually come off with the high valuations, money does flow into gold temporarily as a bit of a safe haven. It used to be the US dollar, so we'd see the Aussie dollar drop as the markets dropped because money would just go into the US and it would be lifted. We're going to expect to see less of that in the next sort of shock. This is what's happening. That's the global market. They're the 3 major trends. If you want to understand how the timing of these announcements and where we see the rankings of these individual Australian gold miners vary based on their news and their type of news, then you can have a look at that podcast that members get. The final one is a simple bit of maths that was explained to me and really was an eye-opener as to how the small cap gold miners outperform the large caps massively. So here's some gold in front of us on screen. Imagine that it costs $100 a tonne to extract for a gold miner. They're selling it for $100 a tonne, they're breaking even. They're barely finding a reason to be in business. They can mothball the mine, possibly. They take a lot to start up, so it doesn't tend to happen. They often run at a loss for some time. Now, if the gold price moves to $110 and their cost of production, all-in sustainable cost, is say $100, they now have a $10 profit. 10% of their cost, phenomenal. They've got great margins. This is brilliant. Now, if it goes from $110, the gold price, to $120, that's about a 10% move in the gold price from 110 to 120. That's okay. But the gold miner's profit doesn't go up 10%. It goes up 100%. They were making $10 an ounce. Now they're making $20 an ounce. So as a shareholder, we're massively happy that the gold price has gone up 10% because our profits have gone up 100%. Now what happens if it goes to $130? Well, their profit was $10 and now it's $30. Our profit's gone up now to 200%. So we've got an extra 200% in profits that we didn't have before. Can you see what's happening here? The companies that are on the fringe, as that gold price goes up further and further, they move from being maybe loss-making to break-even to suddenly profitable. And then that becomes a target for many, many, many reasons. The best one we want as a trader is possibly mergers and acquisitions. We see someone like the companies we listed before, your Ramilius, your Sandfire, your Evolutions, your Northern Star, come in and say, well, you're an enabling asset. We've already got all the infrastructure in the area. We have the rail, we have the ports, we have the haulage, we have the electricity, and you've just proven up your grades and we can see your JORC resources. Let's buy it. We're going to buy that and leverage that up. We already have the economies of scale. We can do it together or we'll just buy it outright. That's what can happen. So when we see these explosive movements of these small mid-cap miners on the ASX, that's part of the reason why they shoot up so much. One, they were probably unviable mines to start off with at say 2,000, 2,500 an ounce. At 3,000, they're profitable. At 4,000, they're massively profitable. And let's accelerate that and get it out of the ground fast to get it to market. Who can do that? Well, those with the established business and the established market and experience to do it, partner up with a large company. It used to be Oxiana, it used to be BHP, that kind of thing, but the gold's a different market now. That's how the profitability happens, and that's why we only see a smaller movement from Northern Star and Sandfire. They have large established companies. They are making more profit, definitely, but they haven't come from a massive negative possibility where the asset was questionably viable, questionably economically viable or sustainable and worth digging out of the ground. So that's a question and a risk to suddenly, yes, it definitely is, to hang on a second, yes, it's massively profitable. So going from a large negative to a large positive sees that explosive movement in the share price. Whereas a gold miner, an established producer like Northern Star, their profits increase and we can calculate what that is. Often they have offtake agreements in futures so that they have already pre-sold them at lower dollars. And we don't know how much is being sold into the spot market. Often we do, but it can be a fraction. So how much that spot market changes right now doesn't actually transpire into the dollars of the next earnings announcement that we get. Not always. The futures curve is important. That's a whole nother video. But this is what we've covered together. These are the leaders. This is what we do see for gold miners, and they're the massive gold mines, so that we understand the scale of the extent that we go to get gold out of the ground and the small amounts that we do. Just to summarize those statistics, the last 3 years, total central buying has been, central bank buying, 3,163 tonnes. That's the strongest sustained in over 5 years, 55 years. US dollar reserve decline from 72% to 58%. That's a 14% decline. Gold price appreciation, 103% in the last 2 years. Record breaking, yes, it surpassed $4,000 an ounce on the 8th of October 2025. And then we have massive number of countries in active political instability. France, Japan, UK, US shutdowns, and then all of the current wars and conflicts that are going on. They're the powerhouse behind the thematic of those three together. Again, here's the disclaimer, not advice. If you want to learn more, click join and you'll get the bonus video that members get. And then there's a whole playlist of top 6 videos and trading education.